Welcome to Oraculum Accounting. In this chapter, we explore the concept of money and understand how it moves through what is known as the money life cycle. This module explains how money originates, evolves, functions, and circulates within an economy, connecting monetary concepts with accounting, finance, taxation, and administrative oversight. First, let us understand the nature of money. Money is a socially accepted medium used to exchange value, measure worth, and store purchasing power for future use. Early societies relied on barter systems where goods were exchanged directly, but this method was inefficient due to mismatched needs and difficulties in valuing different items. Over time, societies began using commodities like grain, salt, and metals, which eventually evolved into standardized coins, paper currency, and later digital money. In the modern economy, money mostly exists in institutional and electronic forms. Bank money represents balances stored in financial institutions and transferred through payment systems such as online banking, cards, and mobile transactions. Although physical cash issued by central authorities still exists, a large portion of financial activity now takes place through digital records within banking networks and financial systems. Numbers play an essential role in expressing the value of money. Economic exchanges require a common and precise unit for measuring worth. As economies expanded, standardized numerical denominations were assigned to coins and paper currency, enabling goods, services, debts, and taxes to be priced consistently. This transformation allowed money to function as a unit of account and made bookkeeping, comparison of value, and financial planning possible. Now let us understand currency. Currency refers to the officially recognized form of money issued and regulated by a country's monetary authority. It includes physical notes, coins, and sometimes officially sanctioned digital balances that are used for everyday transactions. Unlike the broader concept of money, currency specifically represents legal tender that must be accepted for payments and settlement of debts within a country. It is important to understand the difference between money and currency. Money is a broader economic concept that includes bank deposits, digital balances, and financial claims used as a medium of exchange. Currency is a narrower term that refers specifically to the officially issued notes and coins of a country. In modern financial systems, much of the money circulating in the economy exists in electronic form rather than physical currency. Currency itself can exist in two main forms: physical and digital. Physical currency includes banknotes and coins used in direct transactions. Digital currency exists electronically and is transferred through banking systems and payment platforms. Physical currency emphasizes accessibility and immediate settlement, while digital currency focuses on speed, efficiency, and integration with modern financial technology. Next, let us examine how money is created. In modern economies, money is created through the combined roles of central banks and commercial banks. Central banks issue physical currency and control the money supply through monetary policy tools such as interest rates and reserve requirements. Commercial banks create additional money when they issue loans, as new deposits are generated in borrowers' accounts. The issuance of currency is based on the authority of the central bank and the economic framework established by law and policy. Historically, currencies were backed by commodities like gold or silver. Modern economies operate mainly on fiat systems, where money is issued based on government authority and the strength of the economy, rather than direct commodity backing. The value of money is determined by economic forces rather than by a single authority. Within a country, purchasing power is largely influenced by inflation and economic activity. In global markets, the value of a currency is determined through foreign exchange markets, where factors such as trade balances, interest rates, political stability, and investor confidence affect exchange rates. An exchange rate represents the price of one country's currency in terms of another. It shows how much of one currency is required to purchase another in international trade. Exchange rates are influenced by supply and demand in foreign exchange markets, along with factors such as economic growth, inflation, and financial stability. Modern economies also recognize alternative forms of money. Cryptocurrencies operate through decentralized digital networks. Central bank digital currencies are emerging as regulated electronic forms of state-issued money. In addition, private payment balances such as mobile wallets and stored value cards facilitate transactions within digital ecosystems. Another important distinction is between money and wealth. Money is a medium of exchange used for transactions, while wealth represents the total value of assets owned by individuals, businesses, or nations. Wealth includes property, investments, productive assets, and other resources that generate long-term economic value. Now, let us understand the life cycle of money. The life cycle begins with the creation of money through central bank issuance and commercial bank lending. Money then enters the economy through salaries, government spending, business payments, and credit expansion. It circulates through consumption, investment, savings, and taxation. Throughout this process, accounting systems record transactions, financial institutions manage the flow, and regulators monitor financial stability. Tracking and handling money is essential for maintaining financial control. Proper monitoring of income, expenses, and balances helps individuals and businesses maintain discipline, prevent misuse of funds, and make informed financial decisions. Accurate tracking also supports budgeting, compliance with accounting standards, and long-term financial planning. The evolution of financial governance led to the development of accounting, taxation, auditing, and administrative systems. As trade and governments expanded, systematic record-keeping became necessary to track resources, collect revenues, and ensure accountability. Over time, these systems developed into structured disciplines responsible for managing and monitoring economic resources within societies. In conclusion, money is not simply a tool for exchange. It is a fundamental element that supports modern financial, administrative, and economic systems. Understanding how money evolves, circulates, and is regulated provides a strong foundation for studying accounting, finance, taxation, and economic governance. Thank you for watching. For more informative content, subscribe to Oraculum Accounting.